Welcome to the Deep Dive. We're here to cut through the noise and give you the key insights on today's complex stories. And this week, we're diving into Intel Corporation, INTC. Because, wow, the stock just had this massive shockwave, right? A 27% surge.
Yeah, it was huge. And it wasn't your typical earnings beat or anything. This was all driven by this big announcement, a massive strategic partnership, plus a $5 billion investment commitment from NVIDIA, of all companies.
NVIDIA, one of their biggest rivals, stepping in with $5 billion.
No,
That's enormous.
exactly. And it's focused on co-developing data center solutions.
Jensen Huang, NVIDIA CEO, even called it an incredible investment, which, sounds great, a huge psychological boost. But then you look at the actual financials, and Intel is still wrestling with these, well, immense financial challenges. It's this weird mix of excitement and high-risk promises.
It's the perfect storm, really. Creates a lot of tension. So just to set the scene, Intel, INTC, last closed around $30.57. That gives it a market cap of roughly $133.8 billion.
And that recent jump, the 27% surge, pushed it right near the top of its 52-week range. That range goes from about $17.67 way up to $32.38. So it's testing the highs.
Right at the top end.
Okay, before we dive any deeper, especially since we're talking about valuation and stock price, we absolutely have to pause for the disclaimer.
Absolutely critical. So just to be crystal clear for everyone listening, this deep dive is looking at the financial and strategic source materials provided. It's purely for informational purposes, okay? Helping you understand the situation. We are not giving out financial advice.
Not at all.
You absolutely must do your own independent research, your own due diligence, before making any investment decisions. We're just here to unpack the sources we've reviewed.
Got it. Okay, let's unpack that NVIDIA factor then and this valuation tension it creates. Because like you said, it's a real conflict. Huang calling his $5 billion bet incredible, huge vote of confidence. But how does that square with the valuation models we looked at?
Yeah, that's where the paradox really kicks in. So current price, $30.57. The target price we saw, which kind of reflects that post-NVIDIA optimism from analysts, is a bit higher, $32.06.
Okay, close to current levels.
But then you look at the fair value estimate,
Yeah.
derived from the fundamental analysis, and that's way lower, just
Why?
$19.38.
$19. Wow, that is a massive gap. So if the fundamentals suggest it's worth like $19, how are the bulls justifying paying 30? Is that difference purely hope? Is it the premium for this NVIDIA alliance and the turnaround story?
Essentially, yeah. I mean, the market is clearly pricing in the potential for a successful turnaround. And that NVIDIA deal acts as a huge catalyst, a validation point.
And maybe that validation is extra important given where Intel sits competitively.
Exactly. You have to look at the landscape. Intel's market cap, $133.8 billion, sounds big, but compared to AMD at $256 billion, or NVIDIA, which is just this behemoth at $4.29 trillion.
Yeah.
So for Intel, getting this $5 billion nod from NVIDIA, it really does change the narrative.
But okay, help me understand this. Why would NVIDIA, the absolute dominant player, pour $5 billion into a competitor's tech? What's the strategic angle for them?
Well, the sources suggest a couple of things. First, it's likely a strategic hedge, diversification. Relying only on, say, TSMC as your main foundry carries risk, especially with all the geopolitical stuff going on.
Makes sense. Don't put all your eggs in one basket.
Right. And second, they probably want access to Intel's advanced packaging capabilities and definitely their foundry services down the line, especially things like the 18A process node we'll probably talk about.
Ah, okay. So it benefits NVIDIA too.
Oh, definitely. And analysts are pointing out this alliance puts huge pressure on competitors like AMD and ARM. You've now got the two biggest players in data center AI sort of strategically linked.
Okay, that strategic signal is powerful, no doubt.
Yeah.
But let's pivot back to the harsh financial reality, because all that optimism runs headfirst into Intel's pretty severe profitability crisis.
Yeah, the financials are, let's just say, grim. And management hasn't really minced words. They've openly called the operational situation completely unacceptable.
And the last time they actually generated positive adjusted free cash flow for a full fiscal year was 2021.
2021, that's right. So for several years now, they've basically been burning cash instead of making it.
And the scale of that burn is just huge. Looking at the trailing 12-month figures, the TTM numbers, net income is negative $20.5 billion.
$20.5 billion loss.
And free cash flow, negative $10.94 billion, which translates to an earnings per share loss, TTM, of $4.77. I mean, those numbers really show the cost of their struggles.
They really do. And if you want to pinpoint the recent damage, the Intel Foundry segment, IFS, that's the big one, it booked a material operating loss of $3.2 billion just in Q2.
$3.2 billion lost from the foundry alone. Okay, digging into that number, the sources mentioned something specific. $800 million in non-cash impairment and accelerated depreciation charges. Can you break that down? What does impairment charge actually mean in simple terms?
Yeah, that's a really important point. That $800 million isn't cash that walked out the door in Q2. It's an accounting thing, a write-off.
Okay.
It's management looking at past investments, could be older factory equipment, maybe building designs, things like that, and basically saying, you know what, this asset isn't worth what we thought it was. It's an admission that some past decisions didn't work out, and those assets have lost significant value.
So it highlights the need for the restructuring they're doing now.
Exactly. It makes that $3.2 billion loss kind of representative of cleaning up past issues. And on top of that, you've got immediate pressure on their margins. Their Q3 gross margin guidance is looking pretty low, around 36%.
Right. What's dragging that down specifically?
Two main things, according to the sources. One is they're using more outsourced products, basically paying other companies like TSMC to make chips they perhaps use to make themselves.
Which costs more?
Typically, yes. And the second thing is the cost of ramping up new technologies like the next-gen Panther Lake chips. You incur the costs up front before you actually start selling a lot of those new chips and making revenue.
Okay, so the financial picture is bleak, which I guess leads us directly to the bull case, because management is fighting back with this profound and aggressive restructuring effort, as the sources called it. What are they actually doing?
They are swinging the axe, basically. Big-time focus on operational expenses, OpEx. They set these pretty aggressive non-GAAP targets, $17 billion for 2025, then dropped again to $16 billion in 2026.
How do they get there?
A big part is headcount. They're cutting the core workforce by about 15%, aiming for around 75,000 employees.
15%, wow. And they're also hitting capital spending, CapEx, right? Adjusting their manufacturing plans.
Radically adjusting. They've already lowered their CapEx guidance by about $5 billion year to date. They even called some of their past spending unwise and excessive.
Strong words.
Yeah. So they've stopped planned factory projects in Germany and Poland, and they're slowing down construction in Ohio. It's a major pullback from previous plans.
And they're changing how they spend that money too, right? Something about lockstep.
Exactly. They're focusing on deploying CapEx in lockstep with tangible milestones.
Okay, simplify that. What does deploying CapEx in lockstep look like on the ground?
It basically means they're not building these massive, potentially half-empty factory shells way ahead of actual demand anymore.
Which they maybe did in the past.
It seems like it. Now they're waiting for more concrete signs like signed customer contracts or reaching specific technology readiness points, those tangible milestones, before they actually commit the big bucks to finish construction or buy all the expensive equipment.
So shifting from build it and hope they come to a much more disciplined, demand-driven approach.
Precisely. It's a fundamental shift in capital discipline.
And that's a huge part of the bull argument. But then the bear case, it focuses on their competitive position, the erosion of their moat. The sources still give them a narrow economic moat rating, but they also say the manufacturing advantages have kind of weakened.
Yeah, that narrow moat rating is key. Intel still has the strength of the Pi x86 ecosystem, that huge software compatibility base. That's foundational.
Right.
But their edge isn't what it used to be, especially in manufacturing scale, because they've underperformed. And the sources acknowledge they face real performance gaps in crucial areas like high-end servers. They're losing ground to AMD, and there's growing pressure from ARM-based designs too.
And that weakness forces them to compete on price.
Directly. It leads to pressure on their average selling prices, ASPs. We saw server ASPs were down 8% year over year. Performance gaps translate pretty directly into less money per chip sold.
Okay, so performance gaps mean lower prices. But despite the foundry losing all that money, where's the tangible progress? What keeps the bulls hopeful on the technology side?
Well, the hope really hinges on executing their tech roadmap. Despite that $3.2 billion operating loss, they are making measurable progress on the really advanced stuff. The 18A process node, that's their next big thing, is apparently now running actual production wafers in Arizona. That's a major engineering step.
18A in production. That's significant.
It is. And they've also released an early version of the design kit, the PDK, for the next node, 14A, to some key external customers. So these are the crown jewels, the long-term assets that could potentially restore their manufacturing leadership years from now.
Which brings us nicely to their AI strategy. Intel admitted they were maybe too focused just on the silicon before. How are they trying to pivot now to really compete with NVIDIA in AI?
Yeah, they're shifting focus, moving towards a more comprehensive full-stack AI strategy. They seem to realize that just having a fast chip isn't enough anymore.
You need the whole package.
Exactly.
Yeah.
You need integrated software, you need system solutions. So they're aiming to be the sort of complete compute platform provider, designing the software, the systems, and the silicon to work together efficiently for all these new AI workloads.
Yeah.
Moving beyond just hardware.
Okay, so let's try to synthesize this for the listener. You've got this huge external validation boost from NVIDIA juxtaposed against these really deep internal financial problems, and then this massive high-stakes restructuring plan. What's the core conflict here?
It really boils down to execution risk. It's huge. You know, the bull analysts, they get excited about the aggressive cost cuts, new CapEx discipline, the tangible progress on 18A. That all looks good on paper.
Right, the plan looks okay.
But the bear analysts, they hammer on the persistent negative free cash flow, the years of financial underperformance, and just the sheer difficulty, the magnitude of the execution risk involved. Turning around a giant company like Intel while battling dominant rivals like NVIDIA and AMD, it's incredibly tough.
So despite the NVIDIA buzz this week,
Despite that optimism, yeah, the sources are pretty clear. The path back to sustained profitability, back to positive free cash flow. It's going to be complex, it's going to be long, and it's absolutely fraught with challenges and risk.
that sums up the deep uncertainty perfectly. Okay, as we wrap up this deep dive, maybe one final thought for you, the listener, to chew on.
Yeah, here's something to think about. Despite those heavy losses in the foundry, the fact that Intel is, fighting for its financial life in many ways, how might that $5 billion vote of confidence from a massive, dominant rival like NVIDIA fundamentally change the perception of Intel's foundry?
The perception factor.
Exactly. And therefore maybe change its actual financing capabilities, its ability to attract other partners or funding, especially in this high-stakes, geopolitically charged game of bringing chip manufacturing back domestically. That $5 billion might unlock a lot more than just the cash itself. It's a strategic lifeline.
That's an excellent strategic point to consider. Okay, we have covered a ton of ground today, from that 27% stock pop down to billions in cash flow losses and this intense internal fight for survival at Intel. We really hope this deep dive gave you the thorough, synthesized knowledge you need to understand the complexities around INTC right now. Thank you so much for joining us.
Yeah, thanks for listening. And hey, if you found this discussion valuable, please do take just a second right now to subscribe and hit that notification bell. It really helps support the channel and to make sure you don't miss any of our future deep dives. We appreciate you engaging with us.
Until next time, stay curious.